analysis and technical analysis, also known as chart analysis, as tools for predicting share and stock price movement. And share and stock is the same thing. Okay, some people say share price, some people say stock price. So make sure you know these two forms of stock price analysis before watching this video. Okay, now this basic video discusses the basics of efficient markets hypothesis, as well as the basic differences between strong market efficiency, semi-strong market efficiency, and weak market efficiency. Now I know these words sound pretty intimidating right now, but don't worry, you will see how easy and simple it actually is when I show you the examples. Alright, now my next more advanced video will still actually be super easy, and you can find it at mbabullshit.com, and it simply and easily explains how stock and share prices move up and down in efficient markets depending on people's expectations. Alright, so now let's get down to it, to this basic video. Okay, first of all, it's best to recall basic stock investing. Okay, now basic stock investing or basic stock playing or trading or whatever you want to call it, or whatever type, they're not exactly the same. But anyway, in basic stock investing, it's a game of good news versus bad news. Now, what do I mean by that? Well, it depends on sales reports, for example. It could be sales reports, income reports, or profit reports, if you want to call it. Anyway, what does this mean? It means that the good news or bad news regarding sales reports or profit reports are directly related to stock price. Okay, so basically, if the sales reports are good or the profit reports are good, then the price of shares are supposed to, or in theory, the price of shares or stocks go up. Okay, but if the sales reports show that, or if the sales reports of a company are bad, then the share price or the stock price of that same company should go down. Alright? So now, how might people earn money using the news? Okay, how might people earn money using the news? Well, let's just look at this story about Greedy Bob and Greedy Bill. Alright? Now, let's say that Bob here is the CEO of a company, and he sees the latest company sales reports, and he sees that the company is doing great. Okay? Let's just say that this company that Bob works for is listed in the stock market. Alright? So Bob, the CEO, sees the latest sales report, and he sees that his company is doing great. What he might do is he does not announce this report to the public yet, and instead he tells his buddy Bill about this great sales report before telling the public. Now what does Bill do? Okay? Bill buys the stock, or buys the share of stock, before the news announcement about this company's great sales report. Alright? Just make that a bit more visible over here. Before this great sales report. And then, what happens? Bob then decides to announce it to the public, and after the news announcement, the share price goes up. And what happens to Bill? Bill gets rich quick. Why? Because he bought the stock before the news announcement, and then there was a news announcement, and then Bill's share price went up. So Bill gets rich quick. Alright? So that's one way people can earn money, by trading the news. Alright? So basically this is the story about Greedy Bob and Bill. What actually happened here? Okay, what actually happened here? Well, number one, Bob, the CEO, learns about the good news. At first, he tells only his buddy Bill about the good news. Bill buys the stock in advance, and then Bob announces the good news to the public, to people like your grandma, or very often you have these grandma investors who don't know much about the inside information of the company, about the secret information of the company. And then it's only after people like Grandma hear about the news that the stock price goes up. And then people like Bill over here get rich quick. And Grandma here, okay, did not get rich quick because she heard about this good news already after Bill made money on it. So in other words, people like Grandma hear about the news too late together with everyone else. Okay, so she's not so happy over there. And you might say, well, why doesn't she earn money? The stock price still went up. Well, in theory, remember that in stock trading, for you to win, someone else has to lose. Okay, because you buy a stock cheap, or Bill here buys a stock cheap, and then he sells it expensive. Okay, who does he sell it expensive to? Well, he sells it expensive to people like Grandma after the price has already gone up. So in theory, anyway, in stock trading, for you to win, someone else must lose. In this case, Bill won against Grandma. So in theory, Bill bought the stock when it was still low priced, before the announcement, and then sold it to Grandma at a high price after the announcement. Okay. However, this is actually what happens. Okay, this does not happen in what we call an efficient market. Okay, so, well, anyway, another way of saying it is, we saw this bad situation over here. Okay, but actually, in a perfectly efficient market, that would not happen. This bad thing that happened over here, this bad situation between Bill, Bob, and Grandma, this would not happen in a perfectly efficient market. Why? Because in a perfectly efficient market, there's number one, example, there's good news. And then number two, even if Bob is the CEO, Bob, Bill, and Grandma all learn about the good news at the same time, even if Bob is CEO. Okay, in an efficient market, or in a perfectly efficient market. Why is that? Because in a perfectly efficient market, all right, so the key word here is perfectly efficient, all relevant information about the company, okay, such as the sales report, okay, flows or moves or travels instantly or super quickly between Bob, Bill, and Grandma. So Bill does not have an advantage even if he's the buddy of Bob, which is CEO. All right. Now, in MBA bullshit language, all right, in business school bullshit language, okay, instead of saying perfectly efficient market, we usually say strong market efficiency. So if you're in business school, you're wondering what this strong market efficiency is that the textbook or your professor keeps you talking about. They're talking about a perfectly or almost perfectly efficient market, like this situation over here. Like this situation over here, where they all learn about the information at the same time, or almost the same time. Okay, so what does this mean for investors? It means that in a perfectly efficient market with strong market efficiency, at any one time, anyone and everyone already knows all relevant information about a share of stock. So nobody can earn money by using any information, such as this sales report over here. Okay, this sales report over here. Okay. Nobody can earn money using this information to analyze and predict the future share or stock price movements, either up or down. So people like Bill cannot use the information to beat Grandma. Why? Because Grandma already knows the same information too, at the same time that Bill knows it. So it's useless to use inside information. Inside, now, what is inside information? What's the difference between information? Well, what's the difference between information and inside information? Inside information just means the secret information that only Bill and Bob know. Okay, grandma doesn't know it. It's secret. Inside means like secret information or advanced information that Bob knows. But in a perfectly efficient market with strong market efficiency, it is useless to use inside information, fundamental analysis, or even technical analysis to give you or to give Bill an advantage in stock investing. Why? Because fundamental and technical analysis are based on information. And since these two are based on information, how can these two give you an advantage if the information you are using is already known by everyone? Remember, in stock market investing, okay, you have an advantage if you know about this information before other people know it, right? Therefore, Bill also does not have an advantage when he uses fundamental analysis, which uses that information, and he also does not have an advantage when he uses technical analysis, which also uses information, or which is also based on information.
All right. Questions or comments on the video? Open the floor to you first. So one statement I want you to think about, he said in the middle of it, for you to win, someone else must lose. Do you agree with that? The way what he said in the video, that was when he was talking about Greedy Bill and Bob and Grandma. So with the stocks, for you to win, someone else must lose. What we call a zero-sum game. Is the stock market a zero-sum game?
Well, sometimes it's like you just need to cash out and like just sell, so then other people might get a bargain on whatever you're trying to get rid of.
So, and does that mean for sure that you lose because you had to cash out? No. Yeah, I didn't agree with that statement very much. So, if we start thinking about what it depends upon is what your opportunity cost. What he was trying to get at is that Grandma isn't making as much money as maybe she could have because the insider guy, the broker, gets to jump on it quicker, buy low, sell high to Grandma. It doesn't mean that Grandma might still make some money on it, right? He just got to act quicker on the upward movement to it. But the efficient market hypothesis and the strong market hypothesis just means that, and we've seen this evolve over the last 30, 40 years with the internet. That information flow is all happening very quickly so that the broker, the people, the buyers, we're all kind of getting that information set in a relatively quick fashion. You got a comment or question?
I was just going to say, like, you kind of already said it, but like the broker is a quick win, in my opinion, because you could have made money if you held on to it and it went up, but it didn't, so then if you have to cash out,
Yeah.
then the broker wins.
And what he didn't say there is that sometimes people with inside information make mistakes too, and so they're winning and losing on what they think is good information, and they're at it day in and day out. So it's not always, completely for sure either on the broker's part. So
You possibly could have just been talking like very, very short term, like at that exact moment, he's making money and she's not.
well, the Merrill Lynch's and the brokers, they have developed computer programs that will faster than a human being can make a trade in microseconds. And I've read reports that they make millions in less than a second. Now everybody has that technology, but when that technology first came out, like Merrill Lynch developed it or something, they were able to exploit the market because other people didn't have that technology. And so they were able to just like get microseconds of movement, and then they would just dump piles of cash into it and catch that upward movement quicker. And all of that, some people would look at and say, well, that's not fair, that's not good. But from an economist's perspective, that actually brought in other people to doing it. Now it's all fair, they all do it. And it helps keep prices efficient so that we have quick movements on prices. I have one other thing with that. mind when we were. Just a couple other passing comments, and then we'll call it. It's just on the last section of your book talks about behavioral finance, and that's been kind of interesting on is the efficient market hypothesis true or not, and we can look at those biases that we've talked about in other classes, overconfidence bias and the sorting bias and social contagion that just you hear somebody else is doing it, it seems to be good, and so it creates bubbles. So there's a distinction on what we learned with efficient market hypothesis is that prices are unpredictable, and then some other people argue, are the markets efficient in the sense that they're always reflecting market fundamentals? Some people would say there's other factors, the behavioral stuff that might lead to, yeah, you can't predict it, but it's too high because of these other factors, these other biases that are in there. So we'll leave it at that. We'll see you on Monday. Have a good weekend.